What's up, financially curious humans? Or, as I like to call you, future silent millionaires. Today, we're doing a total vibe check on the investing world, and let me tell you, it needs it. Because everywhere you look, there's some guru flexing their leased Lambo, promising you 1000% returns on their latest meme stock pick. They're telling you to do your own research, which usually means trust my gut feeling, bro, and then they disappear when their picks go belly up. Sound familiar? Yeah, I thought so. We're diving deep into the ultimate investing showdown, the quiet, steady power of index funds versus the adrenaline-fueled, often financially disastrous, hype of stock picking. And spoiler alert, one path leads to actual wealth, the other leads to stress, regret, and probably ramen noodles. So grab your overpriced matcha latte, get comfy, because for the next 11 minutes, we're going to dismantle some myths, crunch some numbers, and set you on the path to becoming disturbingly wealthy, without ever having to ape into anything. #### Section 1, the siren song of the stock picker, or, why everyone thinks they're Warren Buffett. Let's be real. We've all felt it. That little whisper in your ear when a stock goes parabolic. What if that was me? The urge to pick the next Apple, the next Tesla, the next company that will literally change the world and make you disgustingly rich overnight. It's the ultimate narrative, right? The lone wolf investor, armed with a spreadsheet and a gut feeling, outsmarting Wall Street, sipping espresso on their yacht. It's the ultimate fantasy of control, of being smarter than the market, of proving you're special. And influencers, bless their hearts, just love to fuel this narrative. They flash screenshots of gains, never losses, talk about diamond hands, and generally create this FOMO-inducing echo chamber where if you're not actively trading, you're missing out. But here's the thing, sweetie, the stock market isn't a casino, and you're probably not a financial prodigy. Studies, like actual, peer-reviewed, not from random TikTok account studies, consistently show that the vast majority of active fund managers, these are literal professionals with teams of analysts and expensive data terminals, fail to beat the market over the long term. And if the pros can't do it, what makes you think your extensive research, aka, scrolling Reddit after midnight, is going to lead to better results? The reality of stock picking is grueling. It demands endless research, staying on top of market news, understanding complex financial statements, and, most critically, having ironclad emotional discipline. One bad news cycle, one geopolitical blip, one viral tweet, and your can't lose stock can plummet. And guess what? Your emotions will inevitably get in the way. Fear makes you sell low, greed makes you buy high. It's a vicious cycle designed to separate you from your money, not help you grow it. The appeal is the thrill, the dopamine hit of a potential win. The reality is the consistent anxiety of potential loss. It's a full-time job for negligible returns, or worse, significant losses. ### Section 2, the silent assassin, how index funds build real wealth. Now, let's talk about the unsung hero, the quiet wealth builder, the investment strategy that's so boring it almost makes you uncomfortable, index funds. What are they? Simple. Instead of trying to pick the single best apple in the orchard, an index fund buys the entire orchard. Or at least, a significant, representative basket of it. Think of an S&P 500 index fund. It holds a tiny sliver of the 500 largest publicly traded companies in the United States. When you invest in it, you're essentially owning a piece of the entire U.S. economy. You're not betting on one company, you're betting on capitalism itself, which, historically, has been a pretty solid bet. Why is this a silent assassin? Because it removes all the stress, all the guesswork, and all the ego. You're not trying to beat the market, you are the market. And historically, the market, specifically the S&P 500, has returned an average of about 10 to 12% per year over the long term. Yeah, that's right. Just by doing nothing, you could have essentially doubled your money every 7-ish years, thanks to the magic of compounding. And you don't need to be a finance bro to understand this. It's diversified by design, meaning if one company goes sideways, RIP Blockbuster, you walk so Netflix could run, your entire portfolio isn't decimated. The other 499 companies pick up the slack. You're not trying to pick the winners, you own them all. And if a company falls out of the index, another one takes its place. It's self-cleansing, self-optimizing, and it does it all without your intervention. This isn't just theory, it's proven by decades of market data. Even legendary investor Warren Buffett himself has advised most investors to simply invest in a low-cost S&P 500 index fund. Section 3, the math doesn't lie, fees are your frenemy. Okay, let's get into the nitty-gritty, because this is where the quiet power of index funds really shines, and where stock picking and actively managed funds shoot themselves in the foot. It all comes down to fees, my friends. Imagine you're investing $10,000. An actively managed mutual fund, the kind that tries to beat the market by hiring smart people, might charge you an expense ratio of 1% to 2% per year. Sounds small, right? Let's say it's 1.5%. Now, an S&P 500 index fund, like Vanguard's VOO or iShares IVV, might charge an expense ratio of 0.03% to 0.09%. Let's just call it 0.05%. That's literally pennies on the dollar. Let's project this out. You invest $10,000 and contribute an additional $500 per month for 30 years, assuming an average market return of 10% per year. Asterisk Scenario 1, Actively Managed Fund, 1.5% expense ratio. Asterisk Your total contributions, $10,000 plus, $500 asterisk 12 by 30, equals $190,000. Asterisk Your final portfolio value, after fees, roughly $750,000, this is a simplified estimate, actual compounding makes this even more drastic. Asterisk Scenario 2, Index Fund, 0.05% expense ratio. Asterisk Your total contributions, $190,000. Asterisk Your final portfolio value, after fees, roughly $1,050,000. Did you catch that? That tiny, seemingly insignificant difference in fees, just 1.45% per year, resulted in a difference of $300,000 over 30 years. That's literally the price of a really nice house, or a lifetime of really good coffee, or a down payment on that Lambo you thought you needed. And this doesn't even account for the fact that actively managed funds often underperform the market before fees are even considered. You're paying more for worse performance, potentially. It's financial malpractice, and it's happening everywhere. The math isn't trying to trick you, it's just telling the truth. Fees are the silent killers of your wealth, compounding just like your gains, but in reverse. Section 4, The Mind Games, Why Stock Picking Messes with Your Brain. Beyond the numbers, there's the psychological toll. Stock picking is an emotional roller coaster. Every dip feels like a personal attack, every surge makes you feel like a genius, until the next dip. You're constantly battling fear of missing out, FOMO, fear of losing everything, FOLO, and the debilitating regret of selling too early or buying too late. This leads to impulsive decisions, chasing hot tips, panic selling, and all sorts of suboptimal behavior that devastates long-term returns. Our brains are hardwired for narratives, for seeking patterns, and for immediate gratification. The stock market, especially individual stocks, provides all of these in spades. You buy a stock, it goes up, you feel smart. It goes down, you feel dumb and maybe a little angry. This emotional churn is exhausting and is the primary reason individual investors underperform even the pros who underperform the market. We get caught in confirmation bias, only seeking information that supports our existing beliefs about a stock. We fall victim to recency bias, assuming past performance will dictate future results. It's a mental trap. Index funds, on the other hand, are the ultimate chill pill for your financial psyche. You buy them, you hold them, you forget about them, mostly. You don't need to obsess over daily fluctuations, analyze quarterly reports, or track CEO tweets. Your mental energy is freed up to do things that actually matter, building your career, spending time with loved ones, learning a new skill, or simply enjoying your life. The best investors are often the ones who do the least. They set a strategy, automate it, and let time and compounding do the heavy lifting. This isn't just about money, it's about peace of mind. And frankly, peace of mind is priceless. Section 5, your playbook to quiet wealth, how to actually do it. Alright, so you're convinced. You want to ditch the hype and embrace the boring path to riches. Smart move. Here's your simple, actionable playbook. 1. Open a brokerage account. If you don't have one, get one. Fidelity, Vanguard, Charles Schwab, M1 Finance, they're all solid. Some even offer fractional shares if you're starting small. 2. Choose your index fund, or ETF. For most of you, an S&P 500 index fund or a total US stock market index fund is ideal. My personal faves for ETFs, exchange-traded funds, essentially index funds that trade like stocks, usually with lower expense ratios and better flexibility for smaller amounts, are *VOO, Vanguard S&P 500 ETF tracks the S&P 500. Low expense ratio. Solid. *SPY, SPDR S&P 500 ETF Trust also tracks the S&P 500. A bit higher expense ratio than VOO, but very popular. *IVV, iShares Core S&P 500 ETF, another S&P 500 tracker from BlackRock. Also great. *ITOP, iShares Core S&P Total US Stock Market ETF, or VTI, Vanguard Total Stock Market ETF. These give you exposure to basically all publicly traded US companies, not just the top 500. Even more diversified. You can't go wrong with either. 3. Automate your investments, dollar cost averaging. This is huge. Set up an automatic transfer from your checking account to your brokerage account every payday. Whether it's $50, $500, or $5,000, consistency is key. This strategy, called dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high, smoothing out your average purchase price over time. It removes emotion from the equation and ensures you're always participating in the market. 4. Hands off, mostly once it's set up, leave it alone. Resist the urge to check your portfolio daily. Resist the urge to sell when the market crashes, that's actually when you should be buying more, if you can. Your job is to contribute consistently and let compound interest work its magic over decades. The longer your money sits, the more it grows exponentially. That's how real wealth is built. 5. Consider international exposure. For extra diversification, you might add a total international stock market index fund like VXUS, Vanguard Total International Stock ETF, or IXUS, iShares Core MSCI Total International Stock ETF, to your portfolio. A common allocation is 70% US/30% international, but tailor it to your comfort level. Look, I get it. The idea of getting rich slowly might not have the same immediate sizzle as a viral stock tip. But trust me, the sizzle eventually fizzles, and you're left with the burnt toast of regret. The quiet, consistent compounding of index funds, however, builds an empire. It's not about flashy gains, it's about consistent, reliable growth over the long haul. It's about securing your financial future, buying back your time, and not having to stress about every market fluctuation. So, if you want to be truly wealthy, not just look wealthy on Instagram, then it's time to stop chasing the Lambo dream and start building a fortress of quiet, undeniable wealth. Ditch the gurus, embrace the boring, and let the market do the heavy lifting for you. Your future self, chilling on a beach somewhere, will thank you. Now go forth and conquer, you magnificent, financially savvy human. Don't forget to like, subscribe, and hit that notification bell if you want more financial truth bombs without the BS. See you next time.